One of the things I noticed about China in the Ingold Trust report, of course, was the fascination amongst the younger generation with gold, with these gold beans. It's a theme. This sort of fascination with gold hasn't really translated to the Western culture as much. And you call it the image problem of gold in the report. So, why do you think this is the case? Why is that distinction different? And, why do you think professional and retail investors in the West view gold with skepticism still?
First of all, I have to say that was really important for me to write about this image problem of gold in the West, because there's like two important narratives when I talk to people in the Western world. And the first one is gold is only for right-wing lunatics, for Nazis, for Trump supporters, for preppers, whatever. And the second one is that gold is dirty and it's useless, and you don't need it, while cobalt or lithium are super important, and we need them for the green transition, whatever. And I think it's important for us in the industry to address those concerns, those things, and this is what we tried in this chapter. So I think, first of all, there's a big divergence between, the view of gold in the Western world versus emerging markets. So when I talk to people from India, from Turkey, from China, obviously, gold for them is being seen as money, obviously, as monetary insurance, as something very, very positive. While in the Western world, many people feel that, especially if you do it for the first time, if you buy physical gold, it's actually something, something kind of mysterious, something that you have to be ashamed of. Yeah. From my point of view, it's an active decision to leave the fiat money system. But many people feel kind of threatened, they've got a bad feeling when they're buying physical gold for the first time. So I think, this narrative, what Ben Hunt calls a narrative machine, and how, strategic communication actually shapes perceptions. We've seen it in Bitcoin, for example. We've seen it with, Bitcoin is only being used for tax cheats, for criminals and so on, and then Bitcoin uses so much energy, and it's used for organized crime. It's unpatriotic. It's only for Putin fanboys. We know how that works, actually, and I think it's also a means of financial repression. We should get in the Western world, for example, in Germany, if you don't want to show your ID when you're buying physical gold, you cannot buy an ounce of gold anymore, because the limit is 2,000 euros, and it's falling in basically every jurisdiction. So I think it's important to address, first of all, that gold shouldn't have this negative image, and then on the second hand, I think it's also important that most of the miners, especially the ones that are listed on the stock market, I think they're doing a tremendous job when it comes to, ESG and building critical infrastructure, building hospitals, schools, well-paying jobs, and so on. So I think those things are pretty important to address, and I think it's also something everybody in this industry has to do to some degree to really change this negative perception that gold has.
Quick break here. This episode is brought to you by West Red Lake Gold Mines. Now, if you know nothing about West Red Lake Gold Mines, let me tell you one thing. This company was founded on the back of a transaction where they purchased the Madsen mine in northwestern Ontario in an area called the Red Lake Gold District, which to date has produced around 30 million ounces of gold from some of the richest gold deposits in the world. Now, what they paid for this mine versus what they got got has led legendary mining entrepreneur Frank Giustra to call this transaction the deal of the decade. And Bob Moriarty, founder of 321 Gold, was recently on my show calling West Red Lake Gold Mines one of the two most undervalued gold companies in Canada. If you're curious why these individuals are so excited about West Red Lake Gold Mines, hit the link below to learn more. Now back to the episode.
Actually, that's the thing, we're pushing against the tide. One of the things I watched a couple of years ago, actually, was an ABC documentary about gold, Australian broadcasting company, I believe. And they were showing gold with these criminals, just, associating them with these like big, muscular, tattooed guys with gold chains coming into the Perth Mint and buying gold. The UK as well, the media, I think they called it an abhorrent tax evasion. I read an article a couple of years ago. So that's the challenge, isn't it? We're pushing back. But I guess one of the ways we can push back against that challenge is by providing optimism, reasons to be optimistic about the future of the gold price itself.
Yes.
And on Twitter, you noted that gold is still not even close to its inflation-adjusted highs. In the report, you make the strong case for the gold price reaching $4,800 by the end of this decade. And more recently, in the August edition of your monthly gold compass, which I definitely recommend our viewers check out, you calculate there's a 2.4% probability that the price of gold will be more than $12,500 by 2030. Now, obviously, that's the top end, but it's still food for thought. So I guess maybe if you could provide some justification for those numbers and maybe some technical analysis as well, if you can.
Yeah, Ted, sorry. We've got, I've sent you a couple of charts before, and I think it's great to discuss them. So, for example, the one on slide 33, which shows our gold price model. We published that in the In Gold We Trust report 2020, where we laid out our big framework for the decade ahead, and we said it's going to be an inflationary decade. Now, back in the days, talking about inflation in 2020, it felt kind of strange, but we said, okay, there are some really strong drivers for us to think that inflation will become more of a concern compared to the great moderation that we talked about. So we came up with this gold price model that has basically it's a very simple model, and it includes, first of all, the future development of the money supply, where we say, okay, what's M2 growth gonna be in the next couple of years, and we've got a base case which would be 3.9%, which was the lowest rate that we've seen since the 1970s. Then 9.7% M2 growth. We say, okay, this has a 15% probability, and then the average M2 growth since over the last couple of decades, which was 6.3%. And then we also calculate an implicit gold coverage ratio. And then we come up with this distribution probability, and you can read it up in Gold We Trust report 2020. And based on these probabilities, we said that the probability weighted peak at the end of this decade would be $4,800. Now, back then, everybody said, you're out of your minds, you're crazy, you're I don't know, potheads, whatever. Now people say, oh yeah, it can happen, but still, I did a couple of keynotes recently with I would say more of a generalist audience, so not like a diehard gold bug audience, but really, generalist investors. And when I say that gold trading at $2,400, that it's dirt cheap, they just shook their heads and they think I'm crazy. So this is, from my point of view, a good sign, because we don't see this irrational exuberance in the Western world, at least. Now, if we do a little comparison, Ted, That's on slide 3 and slide 4. We shouldn't forget in 2008, I remember it really well when we made $1,000 for the very first time. That was, I think, in March 2008 when Bear Stearns broke down. So everybody was excited about, you know, gold trading above $1,000 for the first time. Then it got quite dicey, and you know, the great financial crisis with Lehman Brothers and everything happened. People were desperate for liquidity. They sold gold. Obviously, the Federal Reserve did what they do best. So they lowered interest rates and they started printing. They introduced the first round of QE, but still it took us a couple of months. And I think it was like from March 2008 until September 2009 for really on a sustained basis break above the $1,000 level. And this is obviously a psychological level that is really important for market participants. And then actually within 18 months, the price of gold almost doubled. So we went up 90%. If we move to slide 4, we shouldn't forget that we've been consolidating around the $2,000 level for almost 4 years. And as you know, the longer the base, the higher the space. So now we finally broke out of this consolidation pattern. So can the price of gold actually double in the next couple of quarters? From my point of view, definitely. But I would say for most mainstream investors in the Western world, and they are actually not invested at all. Yeah, you've probably seen those stats by the Bank of America about the average gold allocation of investment advisors, which is, you know, 70% of all investment advisors hold less than 1% gold. So if there's some move from Western investors as well, I think we can easily hit those levels. And I'm not talking about, you know, a big revaluation or let's say a reorganization of our monetary system. So as stupid as it may sound, Ted, from my point of view, relative to other asset classes, relative to its history, relative to historical bull market analogies, relative to debt, obviously, yeah. I think that gold is still dirt cheap.